Well, good afternoon and welcome to HighRock's weekly webinar where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and my partner and colleague Paul Tepsich, the founder of HighRock, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we usually do, let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing becomes even more important this year because of the even greater levels of uncertainty imposed on us by a number of developing factors. Inflationary expectations have been rising, and while other central banks are more cautious at the moment, the U.S. Federal Reserve raised interest rates by 0.25% last week. It is expected that earnings will grow at an approximate rate of 9.8% in 2017, and this has been revised lower from 11.5% at the beginning of the year. Valuations are at a 14-plus year high, which suggests a little too much euphoria in stock markets. And the Trump agenda appears to be running into hurdles. Brexit is finally being initiated. The Dutch said no to populism, and French elections are upcoming in April and May. Meanwhile, protectionism concerns are rising as the G20 finance ministers were unable to agree on an anti-protectionist communique after last weekend's meetings. Well, one of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between stocks and bonds in the US and in Canada as well. We began our advanced approach to portfolio management back in 2015. We added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. Our style is to wait for opportunity and be tactical about how we take it. Well, the benchmark equity index that we use for comparison has returned about 16% from this time last year, but only 4 and 0.35% annualized since this date 2 years ago. This emphasizes the volatility over this time period. Meanwhile, the benchmark bond index has barely had any positive return over the last couple of years, leaving investors with a greater weighting of bonds with little to show for it. And each week I look at how short-term and longer-term returns have progressed in our benchmark ETFs for comparison to client portfolio performance so we can continue to monitor our clients' progress. Each client will likely have different starting points and may have different allocation weighting. So for newer clients, there may be some differences in their personal portfolio returns, especially in the short run. So we want to focus on more longer-term returns because that, in the end, is how we will be judged, achieving your long-term goals. Now, as we look at a longer-term HighRock client, the one-year performance is now ahead of the benchmark, although it had been underperforming over the last couple of months, which highlights how our client portfolios have a lot less volatility than the benchmark as a result of our tactical approach. And as for the long-term performance of about a 4.5-year span, it speaks for itself, well ahead of the long-term benchmark. That is our success, which in turn is our client's success. As I think you all know by now, historical returns are no guarantee of future returns, but at HighRock, as you also know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy. And our forecasts for your net worth into the future are up to date and heading in the right direction. We are watching the inflation story closely. The latest UK inflation revealed that the lower pound since the Brexit vote has pushed prices higher, especially for food and energy. As all central banks have a mandate to maintain price stability, we are focusing on inflation as a key to determine if and when interest rate policy may change. While total inflation data has been rising on a global scale recently, core inflation continues to remain relatively subdued, although it is inching higher. Last week, the Bank of Japan, the Bank of England, and the European Central Bank kept their rates steady. The Fed raised rates by 0.25% in anticipation of the potential for further increases in inflation. One of the reasons for higher total CPI had been the steady improvement in oil prices since the beginning of last year until last week when oil prices dropped by over 10%. Now, this volatility is why central banks like to take out the energy component from their inflation calculations to a better read on core inflation. This week, oil prices are little changed over the course of the week. Commodity prices dropped with oil prices but are up by about 1.5% since then. It is expected that the Fed may raise rates 2 or 3 times through to the end of 2017, taking the rate possibly up to as high as 1.5%. Although the expectations for the first quarter of 2017 GDP have been lowered due to reduced consumer activity. The U.S. Federal Reserve has a dual mandate to seek maximum employment as well as to maintain price stability, and with good job growth in February, this was also part of their decision for raising rates. Now, one of our recession monitors is the shape of the yield curve, a flattening yield curve where 2-year bond yields rise to intersect with 10 and 30-year bond yields has historically indicated that a recession will follow. If the Fed raises interest rates enough, the yield curve could flatten further, pushing the U.S. economy closer to potential recession. On the other hand, if the U.S. economy unexpectedly stalls, falling 10 and 30-year bond yields could also be a catalyst for yield curve flattening. On the week subsequent to the Fed's raising interest rates, the yield curve has, in the United States, has flattened. In Canada, the yield curve followed the U.S. curve flatter as well. The Bank of Canada has its monetary policy on hold for the moment until it gets a better read on U.S. fiscal policy and issues surrounding trade with the U.S., as well as tomorrow's federal budget. And speaking of which, tomorrow the Canadian government's budget will be brought down by Finance Minister Morneau, and while there are no certainties, it is expected that there are a number of deductions, credits, and favorable treatments that may be vulnerable as the government looks to find ways to increase revenue and cover off its deficits. We should be watching closely and reporting back to our clients if there are any issues that need to be made, they need to be made aware of. So stay tuned to our blogs for updates. Well, on the Debt Watch, we have been pointing out the risks of record amounts of global debt with rising interest rates. This puts increased pressure on debt servicing. And that in advanced economies, some countries have experienced rapid house price increases in recent years, including Australia, Canada, Sweden, and the United Kingdom. As past experience has shown, a rapid rise of house prices can be a precursor of an economic downturn. And Canadian household debt as a share of income rose to a fresh record in the fourth quarter of 2016. Data from Statistics Canada last Wednesday showed the ratio of debt to disposable income rose to 167.3%, which means that Canadians owed $1.67 for every dollar of disposable income they received. Total household credit market debt, which includes consumer credit and mortgage and non-mortgage loans, totaled over $2 trillion. Years of low interest rates since the global financial crisis, as well as rising home prices, have prompted Canadians to steadily increase their debt levels. Consumers' ability to pay their debt also remained relatively easy. The interest-only debt service ratio held at a record low of 6.1%, while the household savings rate actually jumped to 5.8% from 5.5%. Now, the household debt service ratio, with its obligated payments of both principal and interest as a proportion of disposable income, edged down to 14% from 14.1% in the third quarter. Now, the Bank of Canada has flagged the elevated level of household indebtedness as a potential vulnerability for the financial system, as consumers with large amounts of debt could find it difficult to adjust to a loss of income or other financial shock. Well, margin debt, the money that investors borrow to buy stocks, is at record highs as well and is now more expensive with the Fed rate increase. When the Fed removes liquidity from the system, financial institutions have a choice: borrow at higher rates or sell assets to increase their cash flow needs. Now, if they sell assets, they will likely sell the most expensive ones, and over the last few days, and especially today, they have been selling expensive equities. As for value, expected earnings for 2017 have been reduced from 11.5% year-over-year growth at the outset of the year to 9.8% now. For the first quarter, earlier expectations of 12.3% year-over-year increase in earnings have been lowered to 9%. Looking forward, prices continue to outpace expected earnings, and with lower earnings expectations and higher prices, the price-earnings ratio has jumped to 17.7 times, its highest level in 14 years. Well, the 10-year average is at 13.9 times. This means that earnings will have to grow by close to 20% more than currently expected to bring the ratio back to its 10-year average, or the S&P 500 will need to correct by 20%, or a combination of the two. At the moment, we don't want that kind of risk in our clients' portfolios. And another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. Interestingly, since 2008, asset prices, which are in blue on this chart, have jumped significantly more than economic growth, which are in pink on this chart. And that tells us something about what might be out of sync here. Recently, retail investors have been piling into stocks with record flows into ETFs and mutual funds, and at the same time, corporate insiders have been selling. And that might spell the peak in the cycle, as emotions have been running rather high. Well, on the geopolitical front this week, financial leaders of the world's biggest economies dropped a pledge to keep global trade free and open, acquiescing to an increasingly protectionist United States after a two-day meeting failed to yield a compromise. Breaking a decade-long tradition of endorsing open trade, G20 finance ministers and central bankers made only a token reference to trade in their communique on Saturday, a clear defeat for host nation Germany, which fought the new U.S. government's attempts to water down past commitments. Until today, volatility on stock markets was falling, while the uncertainty index on a global economic policy had risen to close to new highs. Conservative House Republicans said last night that they had enough votes to block the Republican legislation to dismantle the Affordable Care Act, as House leaders proposed changes to the bill in a late effort to draw support. President Donald Trump intensified his lobbying effort with an appearance this morning at the weekly closed-door meeting of House Republicans. It was Mr. Trump's first huddle with all House Republicans since his inauguration. The nonpartisan Congressional Budget Office last week estimated that the bill would cause 24 million fewer people to be insured over a decade compared with the ACA. A prolonged debate on the health care issue could hold up tax reform, deregulation, and infrastructure spending policies, and this has the markets a little frazzled at the moment. Well, on the Brexit front, Prime Minister Theresa May will officially notify the EU of the UK's intention to leave on March 29th. A summit of EU member states to discuss Brexit is to be held on April 29th, a month after the UK triggers Article 50. Now, in a statement, European Council President Donald Tusk said he regretted but respected the UK's decision to leave the EU and wanted the process of divorce to be as painless as possible for the European Union. the pound has rebounded recently. A little more than 1 month before the first round of voting, Monday's 3-hour debate in France was characterized by finger-pointing and innuendo among the 5 leading hopefuls, with the mainstream candidates jostling for a place in the second round, for which Ms. Le Pen is likely to qualify. Generally, opinion polls indicate that Ms. Le Pen and Mr. Macron are engaged in a tight battle for the first round vote on April 23rd, with an average of 26.2% support for Ms. Le Pen and about 26% for Mr. Macron. Polls back Mr. Macron to then defeat Ms. Le Pen in the May 7th runoff. So here at High Rock, with all the upheaval happening around us, we continue to monitor event risk, which we think is high, and price valuation, which we also think is too high. And we will add or reduce holdings in our models as opportunity presents itself. We will also maintain our disciplined approach to our strategies with skill, competence, and continued deep levels of research, making our tactical approach add value and reduce risk so as to give us all the best possible risk-adjusted returns. Paul, do you have anything to add this week with regards to anything that you've been seeing?
Yeah, I could add one thing, and then I have a question for you as well. But just within the tactical model specifically, we've had, over the past 3 weeks or so, we've had a couple bonds, high-yield energy bonds specifically, that have been called from us. There's been a wave of refinancing, so the corporate issuers are able to call some of these bonds on certain dates, usually at par, which is 100 cents on the dollar, and then they go out and refinance the bond elsewhere in another market, perhaps, or with a new bond in Canada. So we've had natural selling, if you will. We've ended up being taken out of a few positions, which I'm quite pleased with. These bonds, 2 in particular, have worked out extremely well. I just got notification early this morning that one of our, decent-sized holding and certainly our most prolific high-yield energy bond is being taken out in a month. And that bond was roughly a double for most of our clients who were with us when we bought it a year ago. But away from that, I have one question for you. I wonder, about a year ago or so, and I'm speaking about the amount of debt in the global market, in the world that we've accumulated, structural debt. Do you remember, Scott, you used to show a chart? I don't even know where you got it, but it was about what $1 of fiscal spending from a government, probably in the U.S. is where the data was from, how much or how many dollars it took in fiscal spending to create $1 of GDP, gross domestic product, for the U.S. Do you remember that chart?
I do remember that chart, and I'll have to go back and dig it up at some point, and maybe I'll bring it back next week and we can show that.
I wonder if it's updated, because it was probably even over a year ago the last time you showed it, but it's pretty interesting. It kind of puts it in perspective, just how much debt is out there, and it's really dragging on economic growth.
Absolutely, and I will try to resurrect that and maybe get it updated if I can for next week.
Yeah, it'd be neat to see. Thanks.
But I'm glad that you bring that point up, because, as you say, we're starting to see inflation or higher levels of inflation. We're starting to see central banks talking about raising interest rates or cutting back on some of their monetary stimulus, and all of that is going to have an impact on anybody who has significant amounts of debt. So I think that is a very valid point to bring up, and I'll try and address it next week.
Ironically, those with the most amount of debt are governments.
True enough.
And rates go up, boy oh boy. More of their tax revenue goes towards servicing that debt.
Yep.
And just one other notice in the market, certainly today, U.S. bank stocks, which have certainly been leading the U.S. markets higher, and quite frankly other global bank stocks higher. they've been getting hit down pretty hard. Certainly today, I guess, as you pointed out, on the potential for lack of financial deregulation, but even over the past month. And sometimes when we look at, and I'm saying this today because for our listeners who maybe aren't watching the markets much today was the biggest down day we've had in U.S. stocks since October 11th. So whatever that works out to, about 5 months. And the Dow's down about over 1%, and the S&P is down about 1.25%. But if the financials led the markets higher, they're certainly giving up ground here over the past day, and even over the past month. Some of these stocks over the past month are down 7-8%. So kind of sneaky, but worth watching. And the other addition I would have today too, I think I told you earlier, but the down day we had today was on very high, strong volume, which is never really a good sign.
Well, and interestingly, I wrote about it on yesterday in my blog, but for our clients who might be concerned about their exposure to the S&P 500, we continue to have a reasonably low exposure to U.S. stocks because we felt that there has been a little bit too much euphoria that way. But we look for this, perhaps, if it continues a little bit to the downside, to get us back to levels where we may be a little happier to begin to participate in the U.S. equity market.
Yeah, and we could probably even add, I guess, we're sitting on fairly good cash weightings right now, which again we still consider an asset class, and a very protective one at that.
Yeah, exactly.
Good.
Excellent.
Thank you.
Okay, well, thank you. And to our listeners, as always, we want to thank you for taking the time out of your busy schedules to tune in today. If you have any questions or concerns, certainly please feel free to email them to us. We will be back with our next update next Tuesday, but until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Bianca, we want to wish you all a great week.